Welcome to The Explainer. Today, we're going to peel back the curtain on a world most of us only hear about when a huge scandal breaks: the world of forensic accounting. This is the high-stakes game of financial detectives, hunting for truth buried deep inside a company's books.
Okay, let's just dive right in with a number that should really make you pause: 5%. So what does that mean? Well, the Association of Certified Fraud Examiners reports that's what a typical organization loses to fraud every single year. Think about that for a second. It's like this hidden universal tax on business, hitting everything from small local shops to massive corporations. It's a really staggering figure, and it raises some big questions. How are these schemes even pulled off? And maybe, more importantly, who are these specialized investigators that get called in to follow the money and expose the truth?
And the scale is just immense. A recent global report, it looked at just over 2,500 cases and found they accounted for over $3.6 billion in losses. And get this, that's just the cases they examined. The true global cost is almost certainly much, much higher.
Now, fraud isn't all the same. The most common kind is what's called asset misappropriation, faking expenses or stealing cash. But the real company killer, that's financial statement fraud. It happens less often, sure, but the data shows it's nearly 10 times more costly. That's where the catastrophic damage happens.
See, to catch a fraudster, you first have to understand their motive. Investigators use this core concept called the fraud triangle, and it outlines the 3 conditions that are almost always present when someone decides to break the law.
So what is it that pushes someone over the edge? What turns a trustworthy colleague into a criminal? Well, the fraud triangle gives us a pretty clear framework for that journey.
The first side of the triangle is incentive or pressure. This is the motivation, the why. It could be corporate pressure, like a sales manager being told to hit an impossible target or they're fired. Or it can be personal. Someone is drowning in debt or just overcome by greed. It's that initial push.
Next, there has to be an opportunity. This happens when a company's own systems fail. Maybe there's not enough oversight, a super confusing corporate structure, or just weak internal controls. It's basically a door left wide open for someone to exploit.
And the final piece of the puzzle is rationalization. This is the story the person tells themselves to justify what they're doing. It's that internal monologue that makes an illegal act seem acceptable or maybe even necessary in their own mind.
And this is exactly what that rationalization sounds like. The fraudster tells themselves things like, I'm just borrowing it, or the company owes me, or maybe even, hey, everyone else is doing it. It's the self-deception that allows them to cross a line they never thought they would.
Okay, so that covers the why. Now let's talk about the how. Let's open up the fraudster's playbook and see what these schemes actually look like in practice.
Experts have mapped out what they call a fraud tree. It has dozens of branches, and each one is a different type of scheme. But nearly all of them grow from just 2 main trunks. You're either stealing company assets or you're lying on financial reports.
Asset misappropriation is the most common form of fraud by a long shot. This includes things like creating fake vendors so you can pay yourself, keeping a ghost employee on the payroll just to pocket their salary, or simply stealing cash. It happens all the time. But the financial hit is usually smaller.
Fraudulent financial reporting, on the other hand, is the big one. This is not about stealing a few $1,000s. This is about systematically deceiving investors, banks, and the public by cooking the books, inflating revenues, hiding debt, and making the company look way, way healthier than it actually is.
And the consequences are catastrophic. Just look at Enron, which used tricky accounting loopholes to hide billions in debt, and poof, wiped out $74 billion in shareholder value. Or WorldCom, which just started calling regular expenses assets, leading to an $11 billion fraud and $180 billion in losses for investors. In India, Satyam Computers created dummy bills to inflate their revenue, a fraud totaling over $1 billion. These aren't just numbers. They represent shattered companies and ruined lives.
So, when a fraud of this magnitude is suspected, a regular audit just won't cut it. You need a specialist. You need a financial detective.
That specialist is a forensic accountant. Their job is this amazing blend of accounting, investigation, and law.
They don't just check boxes, they hunt for evidence that can actually stand up in court. They untangle these incredible webs of deceit to find out exactly what happened, who's responsible, and how they did it.
And it's so important to understand they are not regular auditors. An auditor's job is to verify if the books are generally true and fair, and they approach them with professional skepticism. But a forensic accountant? They get called in when fraud is already suspected. Their mindset is completely different. Assume there's a crime until the evidence proves otherwise. They don't just sample data, they do a full deep dive investigation.
But how do they actually find the evidence? How can they possibly sift through mountains of data to find one fake entry? Well, they have a few tricks, including one truly fascinating tool. Seriously, imagine you're faced with millions of data points, invoices, payments, expense reports. If someone is creating fake entries, how could you possibly spot them? It seems impossible.
The answer, amazingly, is math. Forensic accountants use a powerful principle called Benford's Law. Now, this is based on a bizarre but true observation. In almost any natural set of data, like financial records, the number 1 is the first digit about 30% of the time. But humans, when we're trying to make up fake numbers, we almost never follow this natural pattern.
Just look at this chart. It's incredible. The digit 1 is the first digit over 30% of the time. The digit 9? Less than 5%. So a forensic accountant can run a company's entire set of financial data through a program. If they see a suspicious spike in numbers starting with, say, 8s or 9s, or way too few numbers starting with 1s and 2s, that is a massive red flag. It tells them exactly where to start digging for the fabricated numbers.
And all of this brings us right back to where we started. The work of these financial detectives is so critical because that 5% fraud tax isn't just some abstract number. It leads to real job losses, to life savings that just vanish, and to serious financial instability. So the question to leave you with is this: if fraud is a hidden tax on all of us, who really pays the final price?